Hello and welcome everybody. I'm Jill Ford and I'm pleased to welcome you to today's media briefing about the Bank for International Settlements quarterly review for March. With me today are Hyun Song Shin, Economic Advisor and Head of the Monetary and Economic Department, accompanied by some new faces for this briefing, Gaston, Head of Financial Stability, and Frank Smets, Head of Economic Analysis and Statistics. So I'll hand over now to Hyun Song Shin to give introductory remarks, and then we'll open the floor to questions. Over to you, Hyun.
Thank you, Jill, and thanks to everyone for joining us today. This quarterly review covers the 3-month period to the end of February. This has been an eventful period, to say the least, and further significant moves have taken place after the reporting period closed. So in my remarks today, let me place the material in this quarterly review in this broader context. Now, it's clear that we're facing a high degree of uncertainty on several fronts. One source of uncertainty is the uneven outlook for growth and inflation across the regions. This is compounded by policy uncertainty, including on tariffs. And the fiscal outlook in major economies is yet a third source of uncertainty. We'll need to take all of them into account to work out the implications for inflation and economic growth. Looking back, the uncertainties have played out most visibly in the bond market. In December and early January, long-term yields in core government bond markets rose sharply, even as policy rates were being reduced. Yield curves steepened as a result, tightening financial conditions and undoing the easing effect of rate cuts. One of the boxes in the overview looks into why yields moved in unison across major economies, despite the growing divergence between strong activity in the US and weaker activity elsewhere. The fact that the steepening has come through higher real inflation-adjusted yields suggests concerns about the fiscal outlook and investors demanding greater compensation to hold government debt in uncertain times. However, the recent rise in European yields has coincided with a risk-on sentiment and a stronger euro, suggesting that the high yields might also be anticipating stronger real activity. Overall, risky assets have been resilient and perhaps surprisingly so, given the pervasive uncertainty. Spreads in corporate credit markets remain compressed by historical standards. Activity in leveraged loans and private credit markets have also been buoyant, supported by buyout activity and in mergers and acquisitions. Stock markets have been uneven, but they remain close to recent highs, with European markets particularly strong. The recent outperformance of European stocks is the subject of another box in the overview. Added to this mix is gold, which has thrived amid the uncertainty and has outperformed government bonds in receiving safe haven flows. While uncertainty has increased, the base case is still for a soft landing for the global economy based on the latest data. Policy uncertainty of all stripes leave households and firms guessing about future policy settings, and prolonged uncertainty tends to lower consumer spending, especially on durable goods. And for firms, uncertainty is a drag on business investment and for hiring. More broadly, uncertainty can put further downward pressure on currencies and thereby pushing up inflation and raising long-term yields. Now, taking all this together, clearly at this time of heightened uncertainty and unpredictability, we need to watch economic and policy developments closely, given their potential to sway financial conditions and real economic activity. The analytical articles in this quarterly review cover a range of topics, so let me turn to those. The first explores the drivers behind the rapid rise in the private credit funds. Fernando Avalos, Sebastian De, and Gabor Pinter find that the footprint of private credit funds is larger in countries with lower policy rates, stricter banking regulation, and less developed banking sectors. The cost of capital for business development companies, which is a type of private credit fund, compared to banks, has steadily declined over the past decade, eroding banks' initial funding advantage. In the second article, against the backdrop of major central bank policy framework reviews, Claudio Borrio and Mathieu Chavaz use a new BIS survey database to describe the changes in central bank inflation targeting since inflation targeting frameworks were adopted in the 1990s. They find that these frameworks increasingly consider employment or growth objectives and have more flexible time horizons, but numerical targets have become more clearly defined. A third article analyzes the relationship between green bond markets and greenhouse gas emissions. Jakob Dembski, Ying-Wei Dong, Patrick Maguire, and Benoit Maujean find that countries with stricter emission policies have seen the most significant growth in green bond issuance, and that issuing green bonds tend to be accompanied by lower corporate emissions. The fourth article examines how corporate bond funds affect market conditions when banks are under pressure, given the closer links between non-bank financial intermediaries and banks. Matteo Aquilina, Giulia Cornelli, and Nicola Tarashev find that inflows to exchange-traded funds, or ETFs, can help alleviate pressure on banks, while outflows from open-ended mutual funds tend to tighten market conditions at the worst possible time for banks. The last article continues our series of explainers on how BIS data can be used to shed light on international financial flows. Torsten Ehlers, Brian Hardy, and Patrick Maguire find that rapid international credit growth can lead to domestic credit booms, posing risks to financial stability. And while local lending by foreign banks provides stable domestic credit, cross-border lending tends to dry up first during financial volatility.
Thank you very much, Hyun. And we now turn to questions. Just a reminder on a couple of things. We'll take questions on Hyun's remarks and the overview first, and followed by questions on the articles. If you can, ask your question by video, and please turn on your camera where possible. We'd also ask if you want to put a question in the chat, we can take the question that way. And if you're by phone and connected, if you could then email your query to media@bis.org. So again, a request, if you can put your camera on, that would be much appreciated for us here in the room. So I'll just take a moment. We've got a good few hands raised. So I'll take, I think, a first hand from Nathalie Olaf Ors from Agence France Presse, excuse me. Natalie, good to see you, Natalie. Hello.
Oh, thank you. I wanted to see you talk about heightened uncertainties. In the last few weeks, it was the annual reporting season for many companies. Some of, for instance, construction company were expecting interest rates to go down, hoping for that to regain momentum. At the moment, with this heightened uncertainty, it is very hard to see for companies what the direction of the interest rate is going to take, and how the central banks themselves are going to handle this heightened uncertainty. How, in your view, can the central banks navigate through these uncertain times?
Thank you very much, Hyun.
Thank you, Natalie. I think interest rates would be sort of one part of the uncertainty, but I think, as I mentioned in my remarks, for long-term investment, for business investment, and for hiring, policy uncertainty in particular, would actually be a dampener on activity. And that when you're investing for the longer term, having a clear sight of where the economy would be very important. And the policy uncertainty in particular is going to be giving companies second thoughts before they commit to actions that have long-term consequences. And I guess in this regard, tariffs are, particularly unhelpful because they, they can be seen as a supply shock, in that, it makes prices stickier coming down, as well as to dampen real activity. But tariffs that are wrapped in uncertainty is going to be, doubly unhelpful. Let me just turn to my colleague Frank Smets if he has anything further to add. Frank.
Maybe just to add that, of course, the central banks can help by focusing on their own mandate and making sure that inflation expectations remain anchored and that way do not add to the uncertainty that's already out there. And in terms of course, they are facing the same types of uncertainty. And in that, to that extent, they, of course, have many of the central banks have put emphasis on data dependence. So the forward guidance is not very effective in a world of very high and elevated uncertainty. And the other sort of principle that many central banks put emphasis on is gradualism, caution. You want to move in small steps when you are in a very uncertain world. And when some of that uncertainty, of course, becomes revealed, then central banks have to be flexible and agile. But as long as the uncertainty is there, some gradualism and caution is probably appropriate.
Thank you.
Thank you very much, Frank. A question has come in from Maureen Khan from The Times, asking about the break in the direction of US and European bond yields seen in the last few weeks, that they're no longer moving in lockstep. And the question is, does this pose any danger for financial stability? And is there a historical parallel for a large divergence? Hyun?
So why don't I start? And I think both my colleagues will probably want to come in on this one. So Maureen, I think it's certainly true that we can think of the review period in two halves. There was that first half when, as I mentioned in my remarks, in December until the middle of January, we saw this huge rise in long-term rates, pretty much in unison across the jurisdictions. And if you read the overview, there is very much a sense that the rise in long-term yields can be attributed to higher, real-term premiums, which is another way of saying that it's not accounted for by expected policy rates or the inflation risk. What's happened since is a bit of a reversal of the things that we saw in the first half. So, for instance, the dollar has changed direction. We've seen the dollar weakening, as the long-term yields in the US has trended down. I mean, it's certainly, not uncommon to have long-term rates, diverge across the major jurisdictions because, the long-term rates will very much, dance to the tune of the monetary policy, direction. And, as the US has maintained rates, what we've seen in other jurisdictions where, in particular, the euro area, has been that, rates have been, have been gently coming down. Now, as I also mentioned, there are some special considerations, especially after the reporting period closed. We have seen a lot of action in the European bond markets, but I don't think this is, it's just markets, doing what it does best, which is to absorb new information, as it comes in. Let me just see if Gaston?
I agree that these are normal adjustments to changes in fundamentals, in reaction to news, and in that sense they are not that unusual. Of course, when there are persistent large deviations in particularly shorter term yields, then that can over time induce the buildup of cross-border positions, of carry trades, and things of that nature. So that means that supervisors and regulators need to be watchful when these kind of disparities persist for some time, because such positions can unravel also quite quickly. Again, we're not seeing this right now, but as a general matter, when such large differences persist, there's a potential for the buildup of such carry trades. Thank you.
Thank you, Gaston. Turning then back, if you could turn your camera on, a question from Alexander Weber from Bloomberg. Hello. Hi.
Hello. Yes, thank you very much. There's a question on a move on the bond market moves, maybe right after the reporting period. I hope that's still fine. Just how exactly do you interpret the large rise in yields in Europe from the German fiscal announcement? Is that an expectations of higher growth and inflation? Does it mostly reflect the expected higher bond supply, or how should one think about it?
Hyun?
Yes, Alexander, I think that's been a very notable move, and we've certainly taken notice of that. What I also mentioned in my remarks was that together with that rise in the long-term bond yields across the major economies in Europe, we also saw a bit of a risk-on tone. So stock markets were quite strong, and the euro actually strengthened quite substantially. Now, I think the way that one can interpret that combination of events, and before we go there, I mean, it's still early days. I think there are some initial reactions. We'll need to see how these moves settle down. But if that turns out to be, more resilient sort of reaction to the news, what that would suggest is that the fiscal announcement is, could be the harbinger of, higher real activity, higher growth. And certainly we've been on the record several times about the importance of structural reforms, about fiscal policy, raising the growth potential in the economy. And so so it's really about how the fiscal resources are used. Does it actually raise growth potential? Does it raise productivity? And I guess, it's not simply a matter of how large is the budget deficit. It's really about what is the impact of that fiscal outlay on medium-term growth. So I think it's still very early days, but it is interesting. It is very notable that the rise in the yields in the last week or so is very different in tone from the yield rises that we saw in December and early January.
Tim has put his question in the chat. He wanted to ask about US and global growth outlook. So reflecting back on the recent falls in markets, reflecting fears of a tariff-induced slump in growth or even a recession, or do falls in market risk transmitting slower growth around the world? So basically, it's really just to get a sense of the outlook following a kind of tariff-induced slump. Again, we're looking back on the period, but please, Hyun, if you can. Thanks.
Well, thank you, Tim, for that question. I think it's a very important question. I think the first thing to say is that the hard data, if you like, the actual statistical announcements that have been coming out, I think still support the central scenario, which is of a soft landing. But clearly, market action is going to sway sentiment. Having said that, I wouldn't put too much weight on the ups and downs of daily moves. I mean, if you remember what happened in August, we had a big market move early in August, and then there were all kinds of commentaries going on. But in the end, that episode was something that was limited pretty much to financial markets. So what happens in financial markets tended to stay in financial markets. I think the larger issue is something that I've mentioned in my opening remarks, which is that when you're thinking of households, thinking about durable goods purchases or businesses, thinking about investment and hiring, some certainty on the policy framework and some certainty on the near-term outlook would be very important. But I think that's been, that part has been, somewhat undermined by all the policy uncertainty. And tariffs would be one, but fiscal would be another important part of that. And so I think the less we can, so the more we can eliminate that kind of uncertainty, that's clearly more growth positive. So I think I would say that. Frank, do you want to add anything to this?
Maybe just to add that, of course, this uncertainty, this policy uncertainty in itself, particularly on tariffs, but more widely on fiscal policy, on immigration policies, on regulation, they, of course, do. I mean, they work like a negative demand shock. So they do have negative effects, or they would have negative effects on spending, on investment, as Hyun mentioned in his introduction. And we see some signs of that, but so far they're relatively limited. If tariffs would be implemented, and some of them have already implemented, then such negative demand shocks may, of course, translate into more like a negative supply shock, and may also give rise to some inflationary pressures. But so far, indeed, the soft landing scenario is still the base case. And that's also reflected in most of the consensus forecasts that are around.
Thank you very much, Frank. I see Mark Jones with a camera on and a hand raised. So Mark, please ask your questions from Reuters.
You're talking about the high uncertainty that we're facing. I mean, would you put it ultimately that the market's trying to grapple with an ultimate change in the Western-led consensus of the world? And I'd be interested to know where you think this level of uncertainty compares to, the recent years. We've had COVID, we've had the financial crisis, etc. Where on that kind of league table are we at the moment?
Okay, so a look back to maybe previous financial cycles. Hyun?
Well, thank you, Mark. I think, compared to COVID, which was, three crises rolled into one, I think, it was first of all, a health emergency, an economic downturn, as well as a, financial stress event. That was a very, very sharp, shock to the economy. I don't think we're anywhere near that. And this is one of the reasons why I think most of the forecasters still see the soft landing as the central scenario. I think what we also see is this somewhat curious divergence between measures of uncertainty from financial markets, for example, the VIX index of implied volatility in the stock market, or the MOVE index and the implied volatility of fixed income markets. Those are actually still very, very low. And it's a sign of, if you like, the kind of divergence that we saw, that I mentioned in my remarks, where risky assets are still actually doing reasonably well. But it's more the policy uncertainty that has been this new element which has injected a bit of a downer. And so tariffs in particular would be something that would actually weigh on activity, and it's also something that also weighs on the disinflation trend that we've seen. And if you have tariffs that are wrapped in uncertainty, then that's clearly going to be even less helpful. So I think that's the way that I would answer your question, Mark. Let me just see if my colleagues would like to come in on this one. No? So I think that's it, Mark. I hope that was okay.
Okay, we have a couple more questions waiting, so we'll press on. So I see Roberto Vozzi with your camera on. Ask a News. If you want to ask your question, please, Roberto.
Thank you so much for this opportunity. I have a question on another apparent divergence that we are seeing between the United States and the European Union. Because on one hand, the Eurozone is pushing through with the creation of the digital euro, digital version of the central bank currency. And you central bankers are quite openly hostile to crypto assets and now maybe perhaps even to stable coins. While in the United States, we see virtually exactly the opposite because the new Trump administration is literally banning the Federal Reserve from pursuing a CBDC, digital dollar, and instead it seems to want to become a sort of global hub for digital assets. The Treasury Secretary Bassett has explicitly stated that they want to use stable coins to maintain the dominant role of the dollar in the monetary system. Now, I assume that if I ask you simply who is right and who is wrong, you won't answer me, but I'm very curious to know if you have concerns about the fact that these two apparently opposite choices could compromise this close collaboration that we have seen for decades between the United States and the European Union on monetary issues, and if this could potentially have also destabilizing effect for the global system, especially because of the fact that apparently they are hostile vis-a-vis of the choice that the other side is doing. US is against CBDCs, and the Eurozone is hostile to cryptocurrency. In fact, they say that even the terminology currency should not be used for these assets. And perhaps today at the Eurogroup enlarged, even stablecoin in dollars will be seen as a potential risk. Thank you very much.
Thank you, Roberto. So just trying to unpack some of that, I think you're trying to ask a question about whether there's a difference in kind of digital assets and the impacts on financial stability. I don't think we'd get into any of the political questions there, but do you want to give that a go, Hyun, in terms
yes,
of
responding? Why don't I start and I'll hand over to Gaston. So Roberto, I think we've worked a lot on the issues surrounding the digitalization and the innovations in the monetary system. We've set out our views over several years on this. Our view is that central bank money should be the basis for the monetary system, central bank finality in particular, and the two-tier system. This has really served us well. And the innovation that the BIS has conducted, certainly in the BIS Innovation Hub, is very consistent with the projects pursued by other central banks, and it's very much based on central bank money. I mean, we don't know enough details about the other initiatives that you mentioned, but just to say, I think for crypto. We've been on the record that crypto is not really suitable as a monetary instrument. Given the speculative nature of those assets, and stable coins in particular, they are really a gateway to the crypto universe. And there are questions that surround the compliance on anti-money laundering and know your customer rules and so on. So I think that would be a very short answer. Let me turn to Gaston.
Thank you. I won't add too much, but just to elaborate also on stable coins, right, that they really do borrow credibility from sovereign currencies, and they piggyback on their credibility on the unit of account that's issued by the central bank. And in that sense, the stable coins are manifestation of the crypto search for a nominal anchor. And of course, we cannot rule out that there could be meaningful uses for stable coins. but to be part of the existing financial system, they really need to deliver on the promise of stability through adequate institutional arrangements and proper regulation and supervision. And here they need to build on the foundations and trust provided by central banks. Thank you.
Thank you very much. Now, I know there's a couple of people waiting a while, and I think we have everybody. So the next one would be Jeffrey Smith from Politico. Jeffrey.
Good afternoon. Thank you very much for taking the question. It's actually a couple of questions, if I can be so bold. One is about just the debt sustainability issue. You've warned many times in the past that advanced economies, Europe in particular, is close to the border of the area of the region of stability. We're now looking at a situation where there doesn't seem to be any way around a big aggregate increase in public borrowing. How quickly do you think the Western Europe in particular will run into debt sustainability issues unless there is at the same time the kind of monetary intervention that we saw at the start of the pandemic? And the second question, which I've almost now forgotten, regarding Claudio's article about the evolution of inflation targeting, is there anything in the research that suggests that those countries that have adopted greater flexibility over the years have achieved better or worse outcomes than those who've stuck with a simple point or range?
Okay, thank you very much, Jeffrey. And Hyun, I think I'll take both of those.
Thank you, Jeff. I think on your second question, I'm going to turn to Frank. In fact, also the authors are in the room, and Claudio is actually online, so he may. But I'll turn to Frank on your first question, which was about debt sustainability in Europe and the region of stability. I think it really depends on if you like, the race between the growth trajectory and the debt trajectory itself, as well as inflation, obviously. I mean, if we do see a noticeable increase in that trend growth, I mean, that's certainly something that would actually help with debt sustainability, and so. I think something that we have observed certainly with the market moves in the last week or so tends to I think lean towards that kind of assessment. If you just look at the market actions, at face value. So I think that's something that we need to watch very carefully as to how nominal debt, how that trajectory compares with the growth trajectory. I think it's certainly worth saying that even within the euro area, the debt capacity across countries would be very different, and so in that respect, I think there may be some reassessment of the different if you like the different capacity across countries for additional debt. But let me turn to Frank on this one. On the second question. Well, actually, also on the third, if you wish.
Let me take
the third question.
Let me take the second question. First of all, I'm personally not aware of research that finds a clear difference in the way central banks react to shocks and to inflation developments, depending on the degree of flexibility. And I also would not sort of exaggerate the differences, because I think what we have seen is that in terms of the inflation target, there has been indeed a sort of a stricter interpretation, in the sense that a number of central banks have moved from having a target zone to a clear point target. Whereas on the dimension of flexibility, there has been sort of the opposite movement. But in fact, so in one way, it has become more stricter, in the other way, has become more flexible. I think the advantage of having a very clear point target, but then some flexibility in the medium-term orientation, that is how quickly do you go back to that target following an inflation shock, is that there's a clear anchor for inflation expectations, which you may not have if you have a target zone. And I think that's one of the reasons probably why some of those targeting frameworks have moved in that direction.
Okay, thanks very much.
Thank you very much. Then we'll move to Li Wei. Li Wei, I see you're up next.
Yeah.
Thank you.
Hyun Song mentioned, can you hear me?
Yes, perfectly.
Yeah. So Hyun Song mentioned the recently dollar change direction. Wondering, what are the factors? Because earlier when there is tariff threat, it's always other currency under pressure, but more recently this seems to be changing. And also, there is some sort of recession fear in the US with the dollar kind of weakening, and also financial and also maybe stock market drop tend to tighten financial condition. Is it fair to worry about recession in the United States? And also for central bank, there seems to be a double challenge of higher unemployment and kind of higher long-term, at least long-term inflation expectation. Is it a worry that you see in the short to medium term for the central bank? Thanks.
Thanks very much, Li Wei.
Thank you, Li Wei, for that question. I think on the dollar and long-term yield and so on, I've already mentioned the fact that during the review period we had this initial period when the dollar was strong, long-term yields were high across different jurisdictions, and there was a risk-off sentiment, and then we saw a bit of a reversal. I think it's too early to tell whether this is going to be a trend or whether this is a decisive reversal. I say that in particular because as financial institutions were taking positions, for the new administration in the US and for if you like the new financial outlook, there was I think there was a very strong consensus, perhaps too strong a consensus, that a stronger dollar, higher yields, risk off would be something that would be sustained. And whenever you have a set of a configuration that is subject to a very strong consensus, any kind of reversal could be subject to sharp short-term moves together with unwinding and so on. So I wouldn't read too much into just the the last couple of weeks moves in financial markets. Now, on your question about real activity, as I said, I think our base case, together with many economic observers, is for a soft landing.